Welcome, everyone. Thank you for joining us for today's webinar on active exchange-traded funds. I'm Sumit Roy, Senior Analyst here at ETF.com, and I'm excited to be joined by two leading experts from John Hancock Investment Management. Brad Feely, who's the Senior Vice President and Director of ETF Distribution, as well as Ryan Wellman, Head of U.S. ETF Capital Markets. Together, they'll dive into the rise of active ETFs, share their expert guidance on due diligence, and explore the benefits and key considerations for evaluating these dynamic investment tools. So if you're looking to enhance your investment strategy and make informed investment decisions, stay tuned for what's going to be a valuable discussion. Let's get started. Brad, Ryan, thanks so much for joining me.
Oh, happy to be here, Sumit. It's our pleasure.
Thanks for having me.
Great to have you both. Brad, let's jump straight into the content. John Hancock recently published a new white paper titled Developing a Framework for Active ETF Due Diligence. What prompted the development of this paper?
Yeah, thanks, Sumit. The short answer was client demand, really the driving force. Ryan, head of capital markets, myself, head of distribution for our ETF business here at John Hancock. We realized we were having this due diligence conversations daily with our key clients and our key broker dealers, and really just wanted to put pen to paper. So to kind of frame what those conversations look like, I think it's prudent to review a little bit about where the industry sits today. Some of your listeners might be very familiar with this, but generally, I think this has been part of the discussion around active ETFs. And so to set a baseline, the U.S. ETF market ended 2023 with just over $8 trillion in listed ETF assets and finished off last year raising just under $600 billion across active and passive ETFs, making it the second best year ever in the ETF industry. To put $8 trillion in context, 2015, so just about 9 years ago, industry sat at $2 trillion. So you can see kind of this upward growth across the industry. It's been pretty impressive. Thinking about active ETFs, why we're here today. Last year, active ETFs raised just north of $130 billion in net new assets coming into active ETFs. That was matched mid-year here through 2024. So looking at the first 6 months of 2024. So the snowball effect is happening. So clearly there is demand. And right now, active ETFs are accounting for approximately a third of inflows into the ETF market. So we've really seen this dynamic shift, which has been driving that demand. So coming back to your question, and think about how these conversations go, I would break them into kind of two distinct talking paths. And interesting enough, we spent a lot of time talking about ETF education. What does the ETF structure bring to investors? And as you know, and probably many of your listeners know, the ETF is really becoming the common way that investors are accessing the markets. So if you think about what are some of the overarching benefits of the ETF structure, generally ETFs offer lower cost to comparable mutual funds. This has really been a driver of flows into the ETF market, maybe for the last decade, but a very important kind of consideration when advisors are looking at ETFs. ETFs offer improved tax efficiency relative to mutual funds. Ryan's going to dive deeper into the creation redemption process and how that affects due diligence. But in general, ETFs have been able to avoid or limit passing through embedded capital gains. This tax efficiency, or this improved tax efficiency, we believe is going to be a fundamental pillar that the ETF will stand on for the years to come. Now, it's in the name, but ETFs offer daily liquidity throughout the day, the traded aspect of ETFs. This has been a hallmark of kind of the first leg of growth in the industry with traded, ability to trade the security throughout the day. As we talk more and more about active ETFs and kind of longer term investment disciplines inside of this structure, that daily tradability kind of loses a little bit of its might, but it's definitely available within the structure. Many ETFs offer daily transparency. Put this in the context of mutual funds, daily transparency on many ETFs. Mutual funds typically offer either month-end or quarter-end transparency into their holdings. So a nice way for investors in this due diligence process to get an X-ray of what's exactly in the portfolio and how those changes from a portfolio manager kind of have evolved through time. ETFs have always been the access point for index or passive investors. And that's what started the industry 30 years ago, continue to be a large portion of the ETF market today. But why we're here today and, looking at the slide, active ETFs are making a big move into the ETF market. And so the ETF structure with everything we just talked about is giving investors and advisors access to that, and that's very exciting. Thinking about that term, access to active investors, I think it's important to think about how that came about to really set like our baseline of education here, and to understand how active became much more of a thing in the ETF structure. We have to go back to 2019. The SEC changed their rules. Without getting into the weeds, but in 2019, the SEC passed SEC Rule 6C-11, which is commonly referred to as the ETF rule. And this rule had two notable effects. One, made it much easier for companies like John Hancock or asset managers to bring ETFs to market. And two, it allowed for custom baskets in the creation and redemption process. Again, Ryan's going to talk more about how this affects the custom baskets affect the due diligence process, but it's an important tool from a portfolio manager standpoint. And this ETF rule really just opened the door to massive ETF product development. So if we go back and kind of level set in 2023, there was 543 new active ETFs launched. We've already seen over 200 new ETFs come to the market here in 2024. So rounding that out, there's a lot of choice in the ETF market, probably why many listeners are on the call here today, trying to how do I sort through that choice, but over 1,200 active strategies across asset classes and investment discipline. So this kind of brings us back to that client demand, right? If we level set on the industry, we've seen the explosion of product, and now we're really experiencing like the maturation of that product. So active ETFs that launched in 2019 or shortly after are coming on their 1 year, their 3 year, their 5 year performance milestones. And advisors are really responding with increased interest and increased usage of this. I always like to refer to it as like the apples to apples comparison. If we go back earlier, you were kind of looking at more of the narrative around a portfolio manager style. Now you can actually judge real live track records as these ETFs mature. And we're seeing it happen with the financial advisors. If you look a decade ago, typical client portfolio held about 10% in the ETF structure. That's doubled today. So over 20% of client portfolios are in ETF. And we feel like that trend should continue upwards. So bringing it kind of all back to your original question, I know there was kind of a lot to level set on, but why did we write this white paper? Why are we here talking today? Given our relationships with gatekeepers and advisors, this topic is coming up daily. We at John Hancock feel we have a unique perspective on the topic, given our manager of manager approach and how we build our investment lineup. And so we wanted to formalize our thoughts and put it down.
Great stuff, Brad. Ryan, I want to bring you into this conversation. As Brad mentioned, there's been tremendous demand and interest in the active ETF space. As the author of the white paper we've been talking about, take us through your thought process on developing this framework.
Yeah, sure. So I say that over the last 6 months, we've seen a lot of demand from home offices and really from advisors for this conversation. They're looking at active ETFs today they're looking to build out rec lists, they're looking to build out active ETF models, and they want to dig in. And I think that in a lot of ways, the product team at John Hancock has been able to position ourselves is on the same side of the table as these research teams because we really are a research team. So if you're not familiar with John Hancock, we have what's called a manager of managers approach. And so we have affiliated sub-advisors. Manulife is our affiliated sub-advisor, and so we can work with Manulife. But if we don't have capabilities internally, we can go out and we can find that capability externally and launch strategies with that manager. And then we also have managers that are actually coming into our office and they're pitching strategies to us all the time. And so I think it's up to us as a product team, as a research team, to really figure out, is the ETF the best structure for this strategy? And I'm biased, but maybe an ETF is not the best structure, right, for the strategy that's being proposed. And then what type of strategy works best? Is it passive, right? Does that strategy follow an index? Is it systematic, like similar to passive, but actually active, so we strip away the index? Is it an active strategy, right? Do you have a stock picker that's able to go into the portfolio and buy and sell securities every day, but that portfolio, we're comfortable with it being fully transparent? Or maybe is the portfolio semi-transparent, right? And we've seen the rise of semi-transparent strategies over the last several years. Maybe large cap doesn't really work well in semi-transparent, but maybe small cap works better. So we have to really think through some of those nuances. But then also, how do we take this strategy that we found internally or that's being proposed to us and tweak it so that it works best, right, in the ETF structure, so that the tax efficiency is there, so that the liquidity is there, so that spreads are tight. So we're always really thinking through those things. So if you just look at our lineup today, and the reason why I'm going to go through this is so you can really see where we have evaluated products and where we've decided to bring different strategies to the market. So we have 14 ETFs today across our lineup, about $7 billion under management, and we have 4 sub-advisors that we work with. Our internal sub-advisor, Manulife, but then also 3 others that are external to us. So we have 5 passive strategic beta strategies. These strategies are sub-advised by dimensional fund advisors, 10-year track record there. These strategies are very, very tax efficient, never distributed capital gain across this lineup. Then a few years ago, we launched 2 systematic dividend strategies. And so they rebalance on a periodic basis, similar to, say, something that's strategic beta, but they actually don't track an index. And so we're actually able to strip out some of the costs of that in these products. And these strategies are very tax efficient, again, because we're able to take advantage of the tax efficiencies of the ETF structure and actually do heartbeat trades with them. And we have 5 active fixed income ETFs. Some of these strategies are, stock picker bond strategies, right? They're managed bond by bond. And then we have some that are more systematic in nature. And then rounding out the lineup, we have 1 semi-transparent ETF that we launched last year. It's a little bit less tax efficient. And this is actually a clone of a mutual fund that we have. And then we have 1 active transparent strategy. It's an international value strategy that's managed by Boston Partners, which is more of a stock pickers fund. And so we have a huge relationship with Boston Partners on the mutual fund side. And this is really our first product with them in the ETF market. So again, kind of rounding it out, we have, your traditional passive sort of index-based smart beta strategies. We have systematic equity. We have semi-transparent. We have active transparent equity, and then a pretty healthy lineup of fixed income strategies, some of which are in-kindable, very tax efficient, some of which are cash create, and we can get into that in a little bit and sort of what drives the tax efficiency there. So if you look at across our lineup, we really have a variety of implementations to go off of.
That's great. So, Ryan, we started off this conversation with Brad telling us about the enormous growth that the active ETF space has seen. And it seems like every day we're seeing new products come to market. Should investors be skeptical about this growth?
Yeah, so I think in general, I don't believe that investors should be skeptical of the growth. I think it's real. I think most strategies that are in the market really deserve to be in the market, but there are certainly some strategies that probably don't deserve to be in the market. And so here are some questions that we really ask ourselves when we build a product. And these are questions that I think, when you're entertaining a new product, when you're speaking with a manager, that we think you should ask the manager, because here are the questions that we ask the manager. So the first thing is, does active make sense here? The bar is very, very high in the ETF industry, and whether people like it or not, in most asset classes, you can essentially invest in the index, and you can really get within a few basis points of the return of that index. And so it's not just enough to evaluate this strategy maybe versus its peer group, but it's like, can this strategy actually add value over its index over time? Because again, the index is essentially investable. And the next thing is that, today there are well over 3,000 ETFs in the marketplace. And what you want to really figure out is this product actually differentiated versus the peer group that solves some allocation problem that you have? You get a lot of managers out there that say, hey, this product is different, but you really need to figure out, like, is it different than what's out there, your active peers? And then is it different from the index that actually helps you solve a problem that gets you to where you need to be in terms of an asset allocation? The next thing is there a track record that you can take a look at? And I'd say that when active ETFs first came out of the marketplace, the asset management business thought, hey, I got this track record sitting over here. It's a manager that we've just been never able to sell. Let's launch it in an ETF and see what happens. And what we found is that didn't really work so well. So I think what you really want to ask that manager is, what is the track record of this manager managing this strategy? Can I look at something similar that they've managed? Is this sort of a proven idea, a proven product? And the next thing you want to ask yourself is the ETF the best delivery vehicle for this product? There are certain asset classes, and I won't get into it on this call, that it's probably a push between a mutual fund and an ETF, and maybe even the mutual fund is better when you factor in the fact that you can't leverage the full benefits of the ETF structure in terms of tax efficiency, and maybe you pay bid-ask spread, and so your total cost of ownership is roughly the same. So I think it's a question worth asking, really evaluating. Should this product, if it's a little bit more esoteric, be in the ETF, or maybe should it be in a mutual fund, or maybe even should it be in a closed-end fund? It is limited, but there are circumstances. And then one question that we kind of get a lot from home offices actually is, how do I know this strategy is going to be around in the future? How do I know that you won't close it down? And I think that there's no silver bullet here. So I think it's best to sort of read the tea leaves. And I've kind of thought about this internally about how we launch product and where we would launch something that we certainly wouldn't want to close down, even if we had limited success in the first, several years after launch. And so I think that criteria really is, is the manager putting their best foot forward here? Are they taking a strategy that they really believe in that's proven in launching it in the ETF marketplace? If that's the case, then I'd say that the asset manager is more willing to let this strategy season and maybe come into its own in terms of its performance profile working out. The next thing is this a flagship team, right? Is this the team that runs a large amount of money in the mutual fund space? Chances are that team is at scale. They're making money. They're not really taking a bet on this team, right? It's something that they're willing to wait for over time to play out. And the next thing is this product, truly differentiated in the marketplace? If a manager launches a strategy that's, one of two, one of one, one of five, and that competition stays limited, chances are, they're going to wait for that product to really come into its own, maybe hit a performance cycle that works where investors start to notice it. If that strategy is 1 out of 50, then, after 5 years, there's a higher likelihood that, maybe the manager thinks seriously about shutting that strategy down. And then the last thing that I'll touch on here is really how was this strategy brought to market? And here are a few things to think about. Is it a new strategy, right? Is this strategy net new to the marketplace, whether it's net new to the SMA, to the mutual fund, to the closed-end fund, to the ETF, across all vehicles? And so here you want to think about, how do you sort of verify the potential for success for this new strategy? The second one is, all right, we're going to launch an existing strategy in a new wrapper. So maybe it's an institutional strategy, right? Manager's been running it for $100 million minimum institutional clients, and they say, hey, we think this will work really well in the ETF. And chances are over there, you'll have something where you could take a look at in terms of track record. The other one is cloned, and we're starting to see maybe some clones out there in the marketplace with just the rise of fixed income strategies are quite difficult to clone, but you're seeing some clones on the equity side, on the semi-transparent side, because you can shield part of that portfolio. And there, the answer is just look at the fund. So that's an easy one to evaluate. The one that's kind of a little bit more nuanced, and just in my opinion, is Cousin. And here, I think it can work out quite well. But I think in general, you should be slightly skeptical of Cousins, because what you really want to make sure is that this manager is putting their best foot forward. You want to make sure that they're not just taking a strategy, say some flagship strategy that they have on the shelf, and maybe they're taking some of the stuff out of it that really makes it work well, and they're bringing it to market in an ETF. So if Cousin, you just want to dig in a little bit more and say, what did you remove from this product to launch it in an ETF? And then how much of the value did that drive? You maybe want to get down into that a little bit more. And then the last one is, on the conversion side, we saw a wave of mutual funds that were converted to ETFs, and I'd say the circumstances around that were quite unique. But I think conversions are challenging for asset managers for a few reasons. I guess the main one being that, in the ETF, in general, ETFs are a little bit less costly, lower expense ratios, and so managers have to cut their fees, and they don't love doing that. But I think that as there's potential for ETF share classes to be approved in the coming years. Right now, there are 20 filings that are in the marketplace. So if the SEC approves something there, what we'll likely see is maybe way less clones, maybe zero clones, and conversions, and just ETF share class kind of in place of that.
Great points, Ryan. You bring up some really important things for investors to think about and questions for them to ask. I want to stick with this due diligence theme. A lot of the investors who are watching right now, they're probably comfortable with active due diligence, and they might even follow the 3 Ps: people, process, and performance. Are there any nuances you would add to the 3 Ps when thinking about active ETFs?
Yeah, sure. So for the white paper, we took a slightly different spin on the 3 Ps, and I'll just take you through them real quick. So on the people side, I think we should look at what is the issuer's commitment to building out their ETF capabilities, right? Are they dabbling? Are they just launching a few random strategies that don't really make sense? Or is this a big part of their future plans? And I think you can kind of tell based on, how differentiated the products are, right? Are these serious capabilities that they're bringing to the marketplace that they have track records in? And then I guess separately from this, that's one way to look at it. But then also, how much does their ETF lineup actually look like their existing mutual fund lineup? Because chances are, if it's a big manager, they have a broad swath of mutual funds that cover, many of the asset classes. And so does that vision to build out the business kind of look like that? I'd say, both of those categories of manager are probably pretty serious about being a player. They just have different philosophies of how to succeed in the marketplace. The next thing is on the people side, does the issuer have strong relationships with authorized participants and market makers? And this can really drive the quality of the execution that investors receive on those larger orders. how well do market makers know the types of strategies, know the portfolio managers, know what types of securities that those portfolio managers will take or not take. That'll drive your execution over time. So it's important to really keep those relationships tight and help bring more market makers really to your ETFs to lower spreads and help investors get better execution. And then lastly, on the people side, it's, does the firm have the resources to help advisors navigate the ETF landscape, whether it's, doing calls like this, that we've done with, a lot of teams, but then also helping them sort through the 3,500 ETFs that are out there, kind of in a non-biased way, and dig through, what can help and maybe what to stay away from. Then on the process side, I think it's really just two simple things. It's how is the ETF capitalizing on the tax efficiency of the ETF structure? Just because it's an ETF doesn't mean it will be tax efficient. You can certainly manage an ETF to be tax inefficient. So it's really asking the manager, what are they doing to optimize tax efficiency, whether it's, again, through systematic, rebalancing, through heartbeat trades, through lower turnover, whatever it is, just understanding that there is a plan in place. And then how is the ETF being managed to optimize liquidity and spreads and help investors get better execution over time? For example, here, is the manager using custom baskets that'll help to minimize spreads? And the last thing, performance really speaks for itself. It's just like with any strategy that you're looking at, and even on historically on the mutual fund side or SMA, it's understanding the performance profile of the strategy and just getting really clear on when you expect the strategy to outperform and when you expect it to underperform, so you can hold it through the cycle and actually achieve that desired result.
Ryan, relative to the mutual fund structure, the ETF structure provides benefits like lower costs, more tax efficient experience, and of course, intraday liquidity. As the active ETF industry grows, will those same high level benefits apply?
Yeah, so I think that these benefits will continue to apply, maybe in general, but not to all ETFs. So it's really important to understand the nuances, and some are in the paper, but I'll just hit a few really quick here. So in terms of cost, this one's kind of easy, but not all ETFs are low cost, and so just when you're evaluating an ETF or a mutual fund or an SMA, if you're paying higher costs, you want to make sure that you're getting true differentiation. That this product is priced maybe a little bit higher because it's different than the index, it's different than the peer group. It's actually different, and there's a clear value proposition for this strategy on when you expect it to add value, versus the peer group, versus the benchmark, and maybe actually that there's a long tenure of this manager of this strategy being successful, and so the manager may think, well, we can bring this to market at a little bit higher of a fee because it's more proven, and so that would be an example of, okay, well then maybe a little bit of extra cost is worth it. But I think you should always be a little skeptical of ETFs that are way outside the range in terms of cost. On the tax side, I would really break it down by asset class, separating out equities and fixed income because they're a little bit different. On the equity side, and just like I mentioned in the last question, but really digging into how the manager of an active strategy is managing taxes. And there are a few ways to think about how a manager would go about tax management. There are really three levers to pull. The first one is obvious, which is just don't trade so much, don't turn the portfolio over as much. Control what you can control, and so you're going to have lower taxes because of that. If you have high turnover, then you actually make the managing of the tax efficiency of the ETF actually quite a bit more difficult. So that's one way. It's just let's keep turnover low. Let's control what we can control. The next piece that sort of helps with tax efficiency is not something the manager can control, but it's more external, which is what are the flow dynamics of the ETF look like? Is money coming in, but is also money going out of the ETF? Because for those strategies that are small, that are seasoning their track record, or maybe that are just in inflows, money's always coming into the strategy, but maybe nothing's leaving. And when redemptions occur and a strategy can redeem securities in kind, that redemption in kind is not a taxable event. So the ETF shares, the ETF sends the underlying portfolio out of the ETF tax-free, whereas a mutual fund actually has to generate cash to send out of the fund, and that's a taxable event. So having that two-way flow, both money coming in but then money going out, will actually help the tax efficiency of the ETF over time. What ETFs do is when that redemption occurs, we have some logic in our tax methodology at our custodian bank at the accounting level that says, all right, look at the portfolio and look at the tax lots in the portfolio, and I want you to take the tax lots that have the biggest gains, right, the largest embedded gains, and I want you to send those out of the portfolio first. And so as redeems are occurring, we're always raising our cost basis in the ETF. And so we're always lowering our unrealized gain burden over time, which should help reduce taxes if something kind of goes awry. But then the last thing is, is the ETF using heartbeat trades to rebalance the portfolio? Rebalances can be done, larger rebalances in terms of turnover can be done tax-free. And so are they taking advantage of that? I guess underneath equity, the only other thing to consider here is maybe on the international side. I'd say, like in general, over the last 10 years, we haven't seen a lot of a tax burden for international equity funds, mainly because international equities, specifically emerging markets, haven't really gone up. And so there haven't been capital gains to realize. But, if international equities, continue to perform well, and if EM picks back up, what you really want to figure out is what percentage of this portfolio is not in-kindable. Again, that in-kind piece helps the manager to manage the tax lots. And for some emerging market strategies, really, the percentage of the portfolio that cannot be delivered out in kind is actually much higher. Maybe it's 20, maybe it's 30%. And so for those countries, say Korea, for example, the manager actually has to go in, sell those Korean securities, get the cash, and send the cash out of the fund. They can't send the securities out. And so if emerging markets have a big run from here, and the manager starts actually having normal redemption activity, that normal redemption activity, which would not affect a U.S. equity fund, could actually have an impact on, say, an EM fund over time. So that's just something to not really relevant now, but just keep an eye on over time. So it's a little bit nuanced. On the fixed income side, I'd say it's a little bit more straightforward. I think the main thing that'll drive tax efficiency over time is the portfolio, is the underlying portfolio of the ETF in-kindable, or is it not in-kindable? So, for example, we have one strategy in our platform. We have several that when market makers create or redeem the ETF, they send the portfolio into the ETF to create, and we send them the portfolio out when they want to redeem. A good example of that would be our investment grade corporate bond ETF, JHCB. An example of a strategy that's, say, cash in, cash out is JHMB, which is our securitized strategy. So securitized bonds in general are not in-kindable. It's cash in, cash out, just like a mutual fund. And so in that case, you have to go out and raise the cash to send it out of the fund. So there could be circumstances where, say, if rates come back down and a lot of these bond funds start making money again, many are sitting on, say, realized or unrealized losses just because, where the 10-year is gone. But if the 10-year comes back down, you could see a situation where the taxable characteristics of some of the fixed income funds actually pick up over time. Shouldn't be drastic, though, but on balance, there is a difference there. And
Ryan,
then on
just to interject here, again, we think this tax efficiency is going to be a major pillar that the active ETFs grow on, right? If you think about just the marketplace, can you get outperformance in a vehicle at a lower cost and avoid that embedded capital gain? So you're going to continue to see kind of that demand from advisors move over to the ETF structure. But we think it's critical to really start quizzing your portfolio managers and kind of the relationship they have with people like Ryan, our head of capital markets, because it's not as simple as just saying, hey, I don't like stock A anymore. I want to be in stock B or bond A to bond C. And I'm going to do that just like buying and selling as a portfolio manager. Knowing the ins and outs of that two-way flow and how to use baskets to move securities in and out of your portfolio, so you're not incurring that capital event yourself from a portfolio manager is a great question. And then the immediacy of like how you trade securities, right? If you're speaking to a portfolio manager that's like has that conviction and like, oh, I need to be in when I see this signal, I need to be out with that signal. That may or may not match up with the two-way flow and basket redemption. So that's going to push those decisions onto the portfolio and make that portfolio manager buy or sell that security themselves. Again, kind of bringing that tax event to the structure. So, as we frame this conversation around questions, I think this is going to be a big one that the industry is going to grapple with and continue to focus on in years to come, because more and more advisors and more clients are coming to the ETF because of that tax efficiency. So if we do see an uptick in ETFs that start paying capital gains on an annual basis, there's going to be a real kind of eye opener for the community. So I think as investors and advisors go through the due diligence process, they spend a lot of time here and truly try to understand what are the capital market functions that the sponsor is working through, how are they trying to mitigate these taxes, and then how is the portfolio manager responding to that, good or bad. So, Ryan, I'll bring it back to you to close out on liquidity, but I thought that's just an important point to put a button on.
Yeah, no, Brad, that was great. Thanks for jumping in. Yeah, I say there's no doubt in my mind, just kind of going off script here, that as the ETF industry continues to grow and as the asset managers continue to launch active ETFs, that we'll see capital gain rates across the industry grow. So again, it's a super valid question that you should be asking, because not all strategies, just because it's an ETF, will be tax efficient. I'd say that one of the things that folks that are in my role across the industry should be doing is on an ongoing basis, looking at the tax status of the fund, figuring out what our unrealized losses and gains look like, how much have we realized, say, year to date, educating the portfolio managers that we work with on a daily basis, like what are the tools that I have available to me that can help you manage taxes, and what are those things that if you do, I can't help you with. And again, one of those things is if you have high turnover, if you're selling with immediacy, if you just sell whenever you feel like there's not a lot we can do. So it's really being, you can have high turnover, but it's being thoughtful about it and working with the capital markets team and making sure that it's done, in a tax efficient way. If you're a tax sensitive investor, certainly if it's qualified money, then it's less important. But if you own ETFs because of the tax efficiency, then it's definitely should be one of the top questions that you should be asking asset managers. So thanks, Brad, for kicking that off. And I guess I'll just kind of wrap up this question just on the spread piece. One of the things that you just want to understand is the underlying liquidity dynamics of the asset class that you're investing in for large orders. And I'd say large orders are different than small orders, and I'll touch on maybe what you can think about there. But really, what does it cost a market maker to acquire that underlying portfolio for those ETFs that can take an in-kind creation, and that will give out the portfolio in-kind on a redemption? And I'd say, quite simply, you're looking at U.S. equities, maybe large caps, 5 basis points or less, maybe, small caps, you're looking at 20 basis points, not always, but say that's generally where things would be. But just getting a feel for what does that look like. And and ask the manager. And it's depending on the volatility that you're seeing in the market, things are going to bounce around a little bit, but at least that way, when you go to execute the trade, you'll know, okay, things are roughly in line with where I'd expect them to be, and I feel comfortable, or things are way are crazy today, and maybe I'm going to hold off. For those strategies, so that's kind of on the in-kind side. But then for those strategies that are, say, cash create, cash redeem, and the number of strategies that are actually in this space are growing every day, cash create, cash redeem, is really how different is this strategy from the hedging tools that the brokers will use to make a market. So, for example, if you look at one of our ETFs, JHMB, which is our securitized ETF, say maybe the broker, if you go out and buy that ETF, the broker will have to deliver cash into the fund at the end of the day. So if you buy that ETF in the middle of the day, they'll sell it to you. Well, they're going to have a little bit of risk between, say 12 o'clock when you buy it and when the market closes, and they have to deliver in the cash. So what are they going to do? They'll obviously go out and hedge it. How close is that hedge to the actual portfolio that they've sold you? And how closely is it going to track? And if those two things, say it's a higher volatility day, those two things don't really track that well. Maybe there's no perfect. There's never a perfect hedge, but maybe it's not great. There's more basis risk. You're going to pay a higher spread. So just having a general idea of how roughly would the broker hedge this? How different is that? Like how idiosyncratic is it? That's going to drive your spread a little bit higher. And the other thing on this cash create, cash redeem is just having a feel for what are the variable fees. So if you have, say, 3 ETFs that are cash create, cash redeem, they may have different variable fees. I'll talk about that in a second. But those variable fees are going to be baked into the spread that you'll pay. Maybe it's within your expectation based on what variable fees are. Maybe it's not. So it's just a good one to know. But I'd say chances are there are ETFs in your portfolio that have variable fees because they're cash in, cash out. So the way to think about variable fees are a great tool, and they're a tool that ETFs use to externalize the cost of putting cash to work in the portfolio to the new shareholder. And so that new money that is coming in, that new shareholder will actually pay the cost of actually going out and crossing spread and purchasing the underlying portfolio. So for example, like in IG corporate, maybe that variable fee is 10 basis points. So the broker sends cash into the fund, then the fund, in addition to whatever is agreed upon, say at whatever the NAV is, gets an extra 10 basis points, and that covers the cost of actually going out and paying offer for the underlying portfolio. This is really only done in the ETF. In fact, this concept isn't implemented in mutual funds. And so if you think about the way a mutual fund works, the existing shareholders in the fund actually bear the frictional costs of shareholders coming and going. Whereas, say, in an ETF, either the whole portfolio is received in kind, no big deal. And if it's received in cash, and there are some transaction costs that the portfolio must bear, the new investor pays those. So I guess it's another advantage of ETFs. But then for those small orders, for the smaller orders, say, 1,000 shares, 500 shares, you've already made your block allocation. How do you tweak the portfolio, or how do you handle new investors? Certainly in scenarios where there's a robust secondary market for ETF shares, that's a great scenario. But there are things that issuers can do for smaller ETFs to help that smaller size. So for example, one of the things that you can ask an ETF issuer is, do you have a liquidity program? Do you sell seed capital to brokers? For our own ETFs, we have our internal seed capital in some of our smaller ETFs. And one of the things that we'll do is work with our market makers that are active in the ETFs, that are active in our smaller ETFs, to actually sell them seed capital. Say if an ETF doesn't trade a lot, if a broker needs to go out and buy new ETF shares, and they're out of inventory, they'll actually have to go out and buy one new creation unit of that ETF, and they'll put it on their balance sheet. And typically, that's probably something as low as $600,000. And in the environment that we're in today, where rates are at 5%, holding that actually costs them a little bit of money, and so they'll bake that into spreads, and they'll push spreads out a little bit more. But if brokers know that they can actually come to the issuer and we'll sell them 5,000 shares, 10,000 shares to top up their inventory because they don't need that full amount, then that helps them. That helps their balance sheet. That helps top up their inventory. And what we've seen is actually they pass that on to our investors in terms of tighter spreads. So there are things that issuers can do to manage that, and it's a good question to ask.
Yeah, I think I love it when Ryan calls it. Ryan kind of gets in his capital markets. He's straight ahead, and investors, Sumit, they love hearing it, right? This is like second and third level like ETF knowledge, and bringing this all back to why we're all here on the call. These are the type of questions advisors want to be asking, their wholesale partner or their capital markets, because if you're not finding this level of intelligence and deepness in the conversation on why they structure things the way they structure them and make those decisions, all should be factored into that people and process side of the three Ps.
Absolutely. Those are great questions and a lot of great insight there, Ryan. Brad, I want to stick with you. You talk to a lot of investors and advisors. What has been the reception in the field to active ETFs?
Yeah, it's I think great is a generic way to say it, but super interesting time for investors, right? Everybody has their own view on interest rates. How's your portfolio going to benefit given your thesis on how those move? The Mag 7 have been a wonderful investment, running stock returns for the last year cycle. Does that continue? Does it broaden out? Do they come back to earth? How much cash is on the sideline? Ryan mentioned a number earlier. Does that stay? Does that go lower? What we're finding is, as advisors and investors try to answer all these questions, as they always do, they're using that ETF vehicle as the implementation tool. So just the volume of conversation has gone through the roof. And then, concurrently, speaking from the advisor's point of view and really the client experience, this idea of like tax alpha or controlling your tax experience for taxable accounts is a major benefit for advisors to talk to their clients about. So as we approach the end of the year, mutual funds go through their process of declaring capital gains and ultimately paying out. So like every year in the past in the ETF industry, like my team and Ryan, we're ramping up for that tax conversation. So reception's been strong from that standpoint. And then I think it's just the enormity of the growth from an advisor perspective is just trying to get their arms around it. You have existing players, you have new players in the space, knowing who does what and well in each individual category. So we're having a lot of conversations on my team, on our own lineup, as well as where we see other sponsors fit into a typical portfolio.
That's great. So Brad, we've talked a lot about the benefits of active ETFs. So given that, what, if anything, is holding them back? What has been the biggest hurdle for investors looking at active ETFs?
Yeah, it's interesting because we are talking about growth, but kind of the thing that's holding advisors in particular back from utilizing more active ETFs is actual access. For the advisor community on the call, generally your home office, your broker dealer, your gatekeeper is going through this process. How do we vet ETF A versus ETF B and put it on an availability list or put it on a rec list or put it into a model at a home office level. And again, going back to like how we started this call, that is really what like the genesis of this paper, because Ryan and I were having these calls daily. So the biggest hurdle, I think, is access. And I think as these analysts and these gatekeepers continue down this road, there's been articles on your websites and other websites talking about like the expanded menu that firms are trying to put out to investors here in the quarters and years ahead. I think that's just going to spur that growth even greater. But yeah, it's been a big hurdle for many of our conversations because just not all active ETFs are available to advisors like where they want to be doing business.
All right, so we got time for just about one more question. Ryan, going back to your original paper, active due diligence, do you have any last words on that topic, active due diligence, for our audience?
Yeah, so I think the most important thing is to just really ask a lot of questions of the issuer, of the manager that you're talking with about the new strategy, and I think it really comes down to 4 questions. First one is understanding, why is this strategy in the marketplace? Why did you launch it? And really, how is it different? Because again, there are 3,500 ETFs out there. You really want to make sure your strategy that you're looking at solves the problem. The second thing is, what is this strategy's performance blueprint? This is probably similar to, how you would look at any strategy that you're evaluating, but when should I expect it to outperform and when should I expect it to underperform? There are a lot of strategies that, aren't tracking, that don't really look like the broader category, that don't look like the index today. And so just, understanding what that expectation is. The third thing is, and this just goes back to what Brad was talking about, what should you expect the tax burden to be over time? And what is that manager doing to manage the tax efficiency? Again, one of the biggest benefits of the ETF structure is the ability to redeem the underlying portfolio in kind, in a tax-free way, which really generates all the tax efficiency. And although there are many benefits to the ETF structure, this one is by far the largest because it puts more money in everybody's pocket at the end of the day for our investors that are tax sensitive. And so really understanding, I think, what is one of the key drivers in addition to performance blueprint, what are you doing to manage taxes? And then I'd say you should have a general idea of what the issuer is doing to manage liquidity and spreads. You should have a general idea of what you should expect your transaction costs to be, buying and selling an ETF, just kind of on a normal basis. Because certainly this is going to impact your total cost of ownership over time. Your total cost of ownership is going to be your taxes that you pay on dividends and capital gains. It's going to be the spread that you pay to get into that portfolio, and then obviously your expenses. And so you want to take those into account. And then I'd say like the final 2 things, just standard stuff, following ETF trading best practices, using limit orders, avoiding the open and the close. Things can get a little, occasionally, it's been a quiet market, although we did have a few big down days. Things can get a little, spreads can be a little wide on the open. And so that's one thing, let the market settle in before you actually go out there and put your orders in. Certainly use your resources on big trades, get to know the capital market desks at the issuers that you work with on a routine basis. They can help you. Obviously, they're not going to do the trades for you, but they can help you find who those liquidity providers are, who those market makers are that are trafficking in that ETF that are comfortable there. And then also, they can give you ideas on how to structure trades if you want, say, for instance, you have a passive ETF and you want to get into an active ETF. There are certain ways to structure those trades to minimize transaction costs. They can help you with ideas there. And then again, investors should really look at the resources that they have available. Your specialists, teams like Brad and his team, and then obviously the capital markets teams.
Fantastic. Well, that's a great place to wrap it up. This was a wonderful discussion. Brad, Ryan, thanks so much for sharing your insights with us.
Great. Thank you.
Thank you.
And a big thank you to everyone tuning in today. A replay of this webinar will be available on the Media Center section of the ETF.com website. Thanks and have a great day.